Hello everyone, welcome back to my channel. So this video is based on what occurred during the past week, the last week of February 2025. The market went through a very difficult period. It came down every single day bar Friday, and so I decided to make this video for you guys because I want to show you that it is possible for you to still make money using options and still beat the market, because at the end of the day, if you are making money and the market is coming down, you are basically beating the market because your shares and the market are going one-on-one, but you are offsetting some of that damage with the options that you are trading. And so because of that, you will be able to beat the market. And I'm going to show you over the course of a week the trades that I did in detail, the reasoning behind it, and this should give you a foundation on how can you basically replicate what I did so that you can successfully beat the market under those conditions and continue to make money as the market continues to drop. And so, without further ado, let's get into it. And so basically, this is the initial situation. At the start of the week, I held 300 shares of QQQ, which is the ETF that tracks the Nasdaq 100 index. Of course, the positions and the weights of each stock on the QQQ do not match exactly the same weights in the Nasdaq 100 index, but still it's a very, very close approximation because that's the purpose of the ETF. And so that's our initial holding for the purpose of this video. And as you follow my challenge, you recall that I bought these shares at $535 each. And so, as I explained, the market went down every single day except on Friday. And because of that, the usual strategy that I adopt with QQQ shares, which is selling 0 DTE calls with a strike price equal to the acquisition price in order for me to break even on the capital and continue to accrue or to gain the maximum amount of premiums, were no longer possible, because as the markets go down, the calls on higher strike prices, in this case 535, are no longer being traded, and so you have to sell other options in order to continue to make money. For clarification, and as I mentioned here, down here, 0 DT options are options that expire on the same day, so you trade them because basically you trade them on a given day and they expire on the same day, so it's basically a one-day option. And for the option seller, and I explained already this in a previous video, they provide the quickest gains because the options are very close to maturity, and so the time value goes down, or the time value of the option goes down the fastest. And because you are the seller, you want the options to go down in value as quickly as possible. Also provides you the most flexibility to adjust the strike price to market conditions, because you are selling options every single day, and as the market moves, you can also move the strike for better flexibility, and to especially if you are selling puts, not calls, but if you sell puts, you can adjust your strike price every single day according to the market conditions. And also they are, in my view, the least risky, because while the market is closed, some adverse event can happen, but during those times you are basically out of the market because you don't have exposure through those options to the market, because they expired at the end of the trading day. And so this is the usual strategy. As you know, if you follow my challenge, this is usually the calls that I like the most to use in the strategy. And as you can see here, the total investment is $160,500, And because this is such a large commitment, it makes no sense to simply do nothing and wait how long it takes, or whatever time it takes for the stock to recover, so that those 0DT calls with a strike price of 535 become available. It can come, the market can come back in a week, can come back in a month, or in several months, you don't know, and in the meantime you are sitting up and doing nothing. And so that was not an option, because this is such a large commitment, and so you need to make some money out of this investment. And so basically what to do, the only way is to keep making money from those shares, or either you continue to sell 0DT options but with a lower strike price, and by doing so you incur on the risk of losing money, because you are if you are assigned the shares, you are forced to sell the shares at the strike price, which is lower than the acquisition price, and so you realize a capital loss. Or in another alternative is to sell longer maturity calls, 2 days, 3 days, 4 days, and keep the same strike. But this entails earning on average a lower average daily premium, and if the stock recovers while the option is still alive, you already collected a very small, relatively smaller premium, whereas if the option expired somewhere in the middle of that maturity, you would be able to sell another call with more premium, because the price of the stock would be higher by that point. So any of these options are possible. Of course, they have their drawbacks, and you can also go for a combination of both ways, as we describe here. And so basically what I did, and the choices of strike price, combinations of strike prices and maturities that I'm going to show you, were simply focused on keep making money while minimizing the risk of realizing losses, basically. So that's it. And so moving on to the beginning of the week, and as you can see right here, we are on February 24th. The stock opens at this price, so it's $527.88, and as you can see, the stock price is already 1.33% below 535, which is quite a lot, given that we are talking about an index, a major index. And because of that, the 0DT options with a 535 strike price were no longer viable. They were no longer available, or if they were available, they had a very, very small premium, so it was not worthwhile to do it. And so basically at market open, as you can see here, at 3:30, so this is Central European time. So at the market opens, when the market opened, we sold 3 calls with a strike price of 535, but expiring on Wednesday. So basically they expire on February 26th. So this entails that we are going to wait 3 trading sessions until for the stock to come back to 535. However, there is another reason for me to pick up this specific maturity, and the reason was that Nvidia would release its earnings after the market closed on Wednesday. So it would be nice to, if the stock would get back on 535, we would sell the shares, and we would no longer be exposed to any potential volatility or losses that would come if the earnings on Nvidia came less than optimal in the eyes of the investors. And so we went for this maturity. We kept the strike where we wanted to, 535, the price of acquisition. And so basically this got us, as you can see here, right here below, we got a net inflow of $333 minus the fee, $101.38. And so this is the net inflow we got, $331.62. And basically we waited, and on Tuesday, the next day, the stock closes at 513 $0.38. And because of this, and as you can see, it went even further down because we had this candle right here and this candle right here. So these were two quite negative days. And so the stock or the options reach the minimum value of 1 cent even before the following trading session. And so even just by going through 2 trading sessions, they were already basically worthless, these calls. So we just bought back those 3 calls. And so we did this also with the purpose of by selling another option earlier, and so we would collect more premium by doing so. And so basically what we did, we bought back these 3 calls because they already lost almost all of their value. And so the trade profit was basically the net inflow that we had in here, and we had to deduct the $3, all right, from each call, and deduct also the fees on this. And so we came up with this profit, $327.44, which gave us annualized return on capital of 74%, which is very good, of course, or just 0.2% in just 2 days. The next day, the stock, as you can see here, the stock closed on $513 on Tuesday. On Wednesday, it opened a little bit higher, 515.53, but at this point, being already 3.64% below $535, it was no longer possible to sell the shares at 535 in just 1 trading session, or rather before the Nvidia earnings were released. And so because of that, we decided to take the risk, because we were still willing to get some premium, but we would like not to have the calls or the options alive while Nvidia releases earnings. And so at market open, we sold 3 options expiring on the same day, 0 DTE, but with a strike price of 525. Why did we use this strike price? This was not by chance. It basically, I did some calculations based on this opening price, and the Nasdaq had to rise 1.84% in 1 day to reach this strike. And given the fact that nothing, no big news, no unexpected good surprises were going to come up, or we're expecting that it will not happen, any expected good surprises on that day. It was almost impossible for the Nasdaq to just rise 1.84%, which is a huge increase in the index. And so this is why we decided to go to this strike. And as you can see here, we also picked the 0 DT calls also to avoid being called in case the prices jump due to Nvidia earnings, because by having this strike, and if Nvidia earnings cause the prices to jump, we could be assigned for this strike, and so we would not want to run that risk. So that's why we chose the 0 DT option again. And this is the net inflow, $41.34. As you can see here, we collected $42 and we deduct 66 cents in fees, and here is the call, right? And so basically at the end of this trading day, the stock closes more or less where it started, a bit further down, 514.56, and because of that, the stock was way below the 525 strike price, so we just let the calls expire worthless. We didn't do anything else with it. Here is the proof of the trade, and we simply collected the entire 40. This is an error right here, by the way. So the trade profit is $41.34. This is my mistake, right? So I just don't bother with this. The profit is $41.34. This is probably because I copied the slide and I forgot to change this number. So please don't consider this number. On the next day and after Nvidia released its earnings, and keep in mind the stock closed Wednesday on $514.56, and so it opened on the next day at 518.13 cents, and so it rose 0.7%, which is quite a lot considering that this was only pre-market trading, so the market was not yet open. This was just the effect of trading outside the market. And so my expectation was that the stock would continue to rise because the earnings and revenue of Nvidia were way above expectation. There were some concerns about the guidance on profit margins, but because this increase in the value of the shares in pre-market was so large, or relatively large, I felt all right, probably the stock will continue to rise, so there's no way we are going to sell calls below the strike price. So we need to look for an option which allows me to get a decent premium with this strike, and of course minimizing the maturity as much as possible. And so I settled on the calls expiring on Monday, March the 3rd. And of course with this strike at 535. Of course, given the fact that it would be very unlikely, as you can see here, that the price would reach the strike just in 3 trading sessions, the Thursday, the Friday, and the Monday. My intention was still to probably rebuy them before the weekend, because the stock, the options will lose most of their value by that specific time, by Friday, at the end of the day. And so we got this net inflow, $39.90, by deducting $2.10 to 42, and so we went for this trade. However, as you can see here in the candle, the stock basically reverted these gains and more. So it went down in a huge way, and it ended up closing at $500.27. And so there were concerns about the profit margins about Nvidia, other economic issues such as tariffs and the consumer sentiment and all that. There were other things also, the non-farm the jobless claims also came higher than expected. So there were a lot of things going on that weighed down on the markets, and so basically the option became basically worthless, even just at the end of that specific trading day. And of course I was not expecting that kind of outcome, and so just before the market closed, 2 minutes before the end of the session, I just bought back all 3 calls, and so I paid the $6 plus the 60 cents in fees, and so this is the profit that we did on this trade, $33.30, and of course with the intention of, on the next day, on Friday, we will sell another call, preferentially a 0 DTE, because there's only one more trading day before the weekend, and I wouldn't like not to have the calls over the weekend, because also not only because of the exposure to whatever happens over the weekend, but usually there might be a change in the market sentiment as we move into another week, and so I would like to start fresh with new options on the next week. And so that's why I decided, all right, let's sell on Friday a 0 DT call. The stock basically didn't move in pre-market. It remained at $500.13, but of course we could not know what to expect, and so I decided to determine the strike price that would for sure not be achieved, not be reached by the stock, but it would be a 0 DTE. And so I settled on 511, right? But I did the calculations. The Nasdaq had to rise about 2.2% in one day to reach this strike. And so yeah, this is almost impossible, especially on a Friday, because Friday traditionally is a day in which there is less trading going on, there's less volume, and so the stock in principle would not have the strength to go up 2.2%. And so basically we sold these calls and we received this money. So basically the $26 minus the 2.16 in fees. And basically what happened is that the stock recovered quite strongly. It went all the way up to $508.17, but still below the 511 strike price. So we just let the calls expire worthless. There was no more trading involved. We just kept the entire premium for ourselves. Of course, these are returns which are very, very much non-expected because they are very low, but still it was the best that we could do, given the fact that we were not willing to take any chances on the strike price. This could be we could have a better return, but we would take more risk because that would entail to lower the strike price, and this is the worst possible thing that can happen, is being forced to sell the shares at a lower price than the acquisition price. We cannot take that risk, and so we prefer to get a lower return but being on the safe side. And so basically what I showed based on the slides that we've just seen, we did 4 trades, and these were the returns that we did on those trades. All right, so this trade lasted 2 days. We basically got 0.2% in 0.2% in 2 days, 0.03% in 1 day, 0.02% in 1 day, and 0.01% in 1 day. And so basically the average rate of return was 0.06%. Now, if you compare this, of course, 0.06%, this is on average. All right, this is the average return that we got on these trades. On the other hand, the market performed much worse, and on average in each of these trades the market lost 1.22%. So even though the market had a negative performance, we were still able to be slightly up. And so that is the power of the options trading for you right here. Now, to wrap this video up, basically, what are the key success factors to make money and beat the market during a crash? Because the stocks, if we don't count what happened on Friday, the pullback on Friday, as you can see here, we went all the way from 527, all right, and $0.88 to just over 508, all right, and so this is a loss of 3.7%. All right, so in a crash, because basically what just happened is that over a week, and we are already considering even if we consider the pullback on Friday, over 3 trading sessions, the index came down 3.7%. And so this is quite a long way. So the market came down by a lot for just 5 trading sessions. And so basically these are the main takeaways from here. So when we sell calls with a strike price below acquisition price, it's important that we stick to 0 DT calls. And why is that? Because if we sell a call with a strike below the acquisition price and we extend the maturity, we give more time to the stock to reach the strike price. We don't want that, because that would mean that we would realize a capital loss, So we can't do that. And as a result, we need to just stick to 0DT calls, because we want to collect the premium, but we don't want to give any chances for the stock to reach the strike price. It is not our intention to sell the stock at that price. And so for that reason, when we sell longer maturity calls, it's very important that we match their strike price to the acquisition price, even if we lose some premium because of that. Because if we give 2, 3, 4 trading sessions worth of time for the stock to come back, it might come back, and if it happens and we get assigned, we need to make sure that we are assigned and we are forced to sell the shares at least at our acquisition price, so that we can break even on the shares. So this is extremely important. However, when we sell longer maturity calls, 2, 3, 4, 5 days, it's important to expect and have some money in reserve, some funds in reserve to buy the calls back, because if the market continues to fall, they will lose their value way before the maturity. So in order for us to maximize our profits, it's important to buy the calls back, realize those gains, and then sell the other calls, sell more calls on a lower strike price, at a lower strike price. This is basically what I did here at the end of the day on Tuesday. All right, so we had one more trading day for the stock, for the options to expire. However, they already became almost worthless by the end of Tuesday, so we simply bought those back, and on Wednesday we sold another option, a 0DT, to expire at the end of that day on Wednesday. So we got more premium out of this, and so basically we because of that we managed to collect overall $41.34 more than we would, of course not considering the costs of buying back these options, but nonetheless we maximized our gains just because we did that. And of course, because you're going to sell at a lower strike price to make up for the fall of the market, make sure that you sell 0DT calls at a reasonable strike price to make sure that you still keep the shares after these other calls expire. And so when we select the strike price below acquisition price, and as you saw on these trades that I did here on Friday, and also here on Wednesday, as you can see here, it's very important for ETFs that track major and of course low volatility index, such as the QQQ, the SPY, which tracks S&P 500, also the TLT, which tracks the behavior of bonds. The strike must be at least 1.8 or 2% above the ETF stock price. And so basically that's what we did. We sell calls which required 1.8% increase to reach the strike, and here on Friday it was 2.2%. So we basically follow this rule for the QQQ. However, for ETFs that track higher volatility index, such as the IWM, which tracks the Russell 2000, which is a small cap index, and by nature small caps are more volatile, and also stocks on individual companies, the strike must be even further above the strike price. And especially if you are talking of highly volatile stocks such as HIMS, for example, a strike of at least 8% above the strike price is adequate, because it's very common for this stock to have swings of 4, 5, 6% on a day, and so you need to be protected against those swings to avoid, as I mentioned already, to sell the stock at a lower price than the acquisition price. And so basically this is it. This is the last slide, as you can see. And so I hope that this clarified what we did and how can we continue to make money and beat the market even when the market goes down. And this is one of the major benefits of trading options. And If you have any questions, any comments, feel free to drop them in the comment section down below. I'm also available on LinkedIn if you want to send me a message and have a conversation more privately, or and also feel free to like the video and subscribe to the channel, and let me know what other videos about this you would like me to do and explain. I would be happy to make that happen for you guys. And yeah, I'll see you all in the next one.